Hi, my name is Jim and I was retired. What is the most important number in your retirement? Stay tuned to this video and I'm going to explain the most important number in my DIY retirement. Now, it's going to be a number that I control. It's not based on the market. It doesn't matter what the risk focus is. It's a number that I control. It's called the net expense ratio of my investments. If I select an ETF or a mutual fund, I look for the fund with the lowest number. Now, in my case, I'm using low-cost, broad-based ETFs to capture the entire equity US marketplace. I'm using VTI. Now, there are some that want to use VOO, which follows the S&P 500, but that's only 500 companies. I'm choosing an index, the VTI, that tracks about 3,500 companies, and I'm doing it with one very low cost investment. Now, when I started this DIY retirement 10 years ago, I knew I did not want to use a 1% AUM. That would be a financial advisor that would take 1% of your invested assets and take it away every year. That's just too expensive. So I nixed that idea and said I'm going to do a DIY retirement. But once you're doing a DIY retirement, you also want to look at the net expense ratios of all of your choices. So I had some Wellington and Wellesley income funds that had about 1/4 point in expense ratios, and I, several years ago, got rid of those for even lower cost, low-cost, broad-based ETFs. You may have some funds in your retirement account or your 401k that look good, but look at the expense ratios, and sometimes they could be over 1%. You're doing worse than the AUM advisor. Look for the lowest cost investments. So for me, VTI was a choice that I can use in my Schwab IRA, even though it's a Vanguard ETF. And that expense ratio is only 0.03%. That's very low for my wife and I. We've selected all of those investments with the lowest cost. If you stay to the end, I'm going to show you 2 investments in our portfolio that are even better than VTI for broad-based investments in the US equities. Now, one of the things that I did in this last week was I calculated the net expense ratio for my entire retirement portfolio, for my wife and I, our retirement portfolio. And it calculates out to 0.044% overall. That's it. Now, one of the reasons is because for bonds, I've stopped using even BND as a 0.3% net expense ratio. However, I didn't like BND, particularly after 2022, and so I elected to go with individually held treasuries and tips that I've purchased and hold to maturity. So there are 0 net expense ratios when you own the bond or the stock yourself. They're only on the ETFs and mutual funds. So that's a little bit of a savings there, and more control over when I cash out of those bonds. I hold them to maturity, so I don't have to worry about BND fluctuating in the market when I go to sell it. I'm always going to be assured that I get my principal and interest as originally contracted when I selected the bond. Now, the other thing I did was I took a look at all of the mutual funds that were actively managed. Those usually have higher expense ratios than a passive index fund. So VTI is a passive index fund. If you are traded publicly in the United States, your stock is included in VTI. And for that one transaction, you've bought them all for a very, very low cost. Well, I'm out here again by the banks of the Cooper River. They're going to have the Connect Cup here this coming weekend. It's another rowing event. And as you can tell, I'm a crew dad. I was, and I love the sport, love to watch it. Drop me a line below if you know anybody that knows where this is, the Cooper River. It's a great rowing venue, and I'm so glad that it's close to my neighborhood. As I said earlier, there are two investments in our retirement portfolio that are even better than VTI. My last job was a very good institution with a very good 401k with institutionally traded funds that are ridiculously cheap. I actually stayed and kept invested in the 401k primarily because of the very low costs of investing within the fund, as well as the ability to trade within the 401k to make Roth 401k conversions and other things. But that was one of the reasons. It has an equity index fund, which is primarily close to the VTI in definition, and its expense ratio is 0.006. With that low expense ratio, I kept the net equity investments in that fund, and I traded away from, by the way, target date funds in the original 10 years ago. I said I could balance my own retirement. I didn't need to do a target date fund. So I traded away from those and into the broadest based index funds within the 401k. And that included a ridiculously cheap equity fund for US stocks and a pretty cheap fund for international stocks, and a very, very low cost for small company stocks. Interestingly enough, the REIT choice was higher than things like FREL, which has a 0.08% net expense ratio. So where we have REIT, we have selected something in our IRAs that is cheaper than we could get at this 401k. The other cheaper equity broad-based fund that we have is in my wife's Fidelity IRA, and it's FZROX. Hold your hat. It's a 0.000% net expense ratio. That's right, it's a zero fund. They do that by selecting something close to a broad-based index fund, but don't pay S&P or somebody else a marketing fee to use that. They select their own company index. It's proprietary, so when she goes to sell out of Fidelity, she will have to cash that out. She can't trade that out. It's not like VTI, an asset you could take someplace else. The zero fund, though, is zero. So her equity investments is in that, the zero fund. She also has a zero international fund. You can't beat those choices. Focusing on these little expense ratios has actually been a boon to our retirement. It means that we have less going out of our pockets into somebody else's pockets for the investments that we're choosing in our retirement. Now, you could construct something in the portfolio by bucket spreadsheet that takes a look at your net expense ratio, and I'm going to explain it briefly to you and not on the screen, so pay attention. There on one of the bucket sheets, you'll find your weight of assets. That is the percent that individual asset is within the entire portfolio. Next column over, construct yourself a place to put the net expense ratio of all of those choices and plug them in from your 401k or your broker or where you have your IRA. Be sure to use zero for any treasuries and tips that you are purchasing yourself with no expense ratio at all, and then times the weight of the asset by the expense ratio to give you the weighted contribution to your expense ratio. Then add all of those up, and that's how I calculate it. Our net expense ratio is 0.044% for the entire thing. That's extremely low expense ratios. Now, question, why VTI versus some other broad-based index fund like VOO? Well, VOO is only 500 companies. VTI is 3,500 companies. You're automatically getting mid and small companies in the index fund all in one. So it's a broader base. They are equally cost effective. They're both expense ratios are very low. But if you're doing a one size fits all equity bucket of US stocks, VTI is a better choice. I also, as I go with a rising equity in the coming year, we're going to go up actually to a 75-25 equity once Social Security fully kicks in. That broad base means I don't need to touch the equity for 8 to 10 years. And that VTI will give the opportunity for small cap companies to contribute to growth potential. I have no idea which of those 3,500 companies is going to be the next Anthropic, the next big thing. Rather than try to find the needle in the haystack, Jack Bogle said, buy the haystack. Now, with ETFs, he was right that once they're ETFs, they're likely to be traded, and that's the wrong way to use a broad-based passive index fund like VTI. Buy it and hold it. Don't trade it. Don't try to decide, should I go with VIG this year, or should I go to VB for the small, or should I try to find a tech stocks? Rather than try to find the slice of the haystack that's going to win in the coming year, I have no way of knowing. You don't either. You can focus on that net expense ratio. It's the best number that you control yourself. Nobody controls that but the choice that you make to pay that much. Some of those other actively traded ETFs come with pretty high expense ratios. Granted, not as high as some of the mutual funds that I've seen in people's 403Bs and 401Ks with very bad choices. There are some, again, that as I've said before, are worse than a 1% AUM. They're really, really not productive. And if I had a 401k that had those kind of choices, I would have cashed out and put it into an IRA where I get to control the expenses. But because I had a 401k with some great expense ratios on the investments, I kept my money in the 401k. Make that choice. It's yours to make, and it's a lot easier to pick the right expense ratio than it is to try to pick the next sector to win in the stock market. Listen, I am not a professional. I have no initials after my name. So take this as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. Hey, be sure to like and subscribe and share this channel with others who are interested in a DIY retirement. And that is one where you control how much you spend on your retirement investments.